Stop waiting for the perfect market. That is the title of this video, and it is also the most direct investment advice I can give you in 2026, because the data does not support waiting. And I am going to show you exactly what the data says, what it means for a W2 investor right now, and how to make a rational buy or wait decision based on your specific financial situation rather than on fear, headlines, or the hope that mortgage rates will drop to 3% again sometime before you retire. Let me start with the argument for waiting, because it deserves to be taken seriously before I dismantle it. The case for waiting goes like this: interest rates are still elevated compared to the historic lows of 2020 and 2021. Home prices have not corrected meaningfully in most markets despite those higher rates, and there is a reasonable chance that rates could come down over the next 12 to 24 months, which would both lower your borrowing cost and potentially unlock more seller motivation. If you wait, you might get a better rate, a lower price, or both. That argument is not crazy. It is just incomplete, and the part it leaves out is what waiting actually costs you. Here is what the data says about timing the real estate market. Investors who attempted to time their entry around interest rate cycles, buying only when rates fell below a certain threshold, systematically underperformed investors who bought on cash flow fundamentals regardless of the rate environment. The reason is straightforward. Every month you spend waiting is a month your tenants are not paying down your mortgage. Every month you wait is a month of rent appreciation you are not capturing. Every month you wait is a month of depreciation deductions you are not taking. And every month you wait, the down payment sitting in your savings account is losing purchasing power to inflation at a rate that almost certainly exceeds the interest it is earning. Waiting has a cost. It is just a cost that never shows up on a spreadsheet because you are calculating the deal you might do instead of the deal you are not doing. Now, let me be precise about what the 2026 market actually looks like, because generalizing across the entire US real estate market is a mistake. There is no single market. There are thousands of local markets, and they are behaving in dramatically different ways. Coastal markets Los Angeles, San Francisco, Seattle, New York, Boston are still priced at levels where cash flow is nearly impossible at current rates for the average investor. These are not buy markets in 2026 for most W2 investors. Full stop. If you are waiting for those markets to make sense on a cash flow basis, you may be waiting indefinitely. The math in those zip codes has not worked for yield-focused investors for years, and elevated rates have only made it worse. Midwest and Sunbelt markets are a completely different picture. In Indianapolis, Columbus, Kansas City, Huntsville, and Cincinnati, markets I have covered in detail on this channel, inventory has increased modestly over the past 12 months, which has given buyers more negotiating power than they had in 2021 and 2022. Days on market have extended, which means sellers are more willing to negotiate on price and more likely to offer concessions like rate buydowns. Median acquisition prices in quality rental zip codes in these cities remain in the $160,000 to $200,000 range. Rent growth has moderated from the sharp spike of 2021 and 2022, but it has not reversed. Rents are stable to slightly growing in most of these metros, which means the income side of the cash flow equation is holding. This is not a distressed market, it is a normalized market, and normalized markets are exactly where disciplined buyers do well. Here is the specific rate buydown math that changes the 2026 calculus for investors who understand how to negotiate. At a market rate of 6.5% on a $135,000 loan, 25% down on a $180,000 purchase, your monthly principal and interest payment is $854. If you negotiate a 2-1 buydown paid by the seller as a concession, your effective rate in year 1 drops to 4.5% and your payment drops to approximately $684. That is $170 per month back in your pocket in year 1, often the exact margin between a deal that barely cash flows and one that comfortably clears your threshold. In year 2, at 5.5%, you are at approximately $767. By year 3, you are at the full rate, but by then rents have typically increased enough to absorb it. Sellers in today's market are paying these concessions regularly because the alternative for them is continued carrying costs on an unsold property. You do not need rates to drop. You need to negotiate correctly in a market where sellers have softened. Now let me give you the framework for making the buy or wait decision as it applies specifically to your situation. There are 3 conditions under which waiting is actually the rational choice. First, if you do not yet have a full expense stack analysis on at least 10 real properties in your target market, you are not ready to buy, not because the market is wrong, but because you do not have enough data to know a good deal from a bad one. Waiting while you build that analytical foundation is productive waiting. Second, if your down payment capital would drop below 3 months of living expenses after closing, you are not in a position to absorb the inevitable early surprises that come with a first rental property. Build that buffer first. Third, if your debt-to-income ratio is above 43%, most conventional lenders will not approve you anyway. The waiting period should be used to pay down existing debt and improve your lending profile. Every other reason for waiting is almost certainly fear dressed up as patience. I'm waiting for rates to drop is fear. I'm waiting for prices to correct is fear. I'm waiting until I feel more ready is fear. None of these are data-driven positions. They are emotional responses to uncertainty, which is completely understandable. But they are not investment strategies. Here is the test I use when I'm evaluating whether to move on a deal or hold off. I ask one question: if I buy this property today at these numbers and rates stay exactly where they are for the next 5 years and prices neither rise nor fall, do I still win? If the answer is yes, if the cash flow is positive, if the mortgage is being paid down by rent, if the depreciation is sheltering my income, then the deal makes sense at current conditions without requiring any future improvement in the rate environment or the market. I never buy a deal that requires rates to drop or prices to rise to justify the investment. I only buy deals that work at current conditions and benefit from future improvements. That filter eliminates most of the risk that people associate with buying in a high-rate environment. The investors who built real wealth through real estate did not do it by waiting for perfect conditions. They did it by buying good deals in good markets when conditions were acceptable, not optimal, and holding long enough for the four wealth-building mechanisms: cash flow, pay down, appreciation, and tax efficiency to compound into something significant. The investors who waited for perfect conditions in 2018 missed 2019 and 2020. The investors who waited for rates to normalize in 2023 missed 2 years of rent growth and mortgage paydown in markets that continued to perform. The pattern repeats. Your action step from this video is not complicated. Pull up your target market, one market, not 5, and find 10 active listings that fit your acquisition criteria. Run the full expense stack on each one: mortgage, taxes, insurance, vacancy, management, maintenance, capex. Find the 2 or 3 that get closest to your cash-on-cash threshold. Make offers on those 2 or 3. Negotiate seller concessions. See what comes back. You will learn more from that process in 30 days than from 6 more months of watching videos and waiting for certainty that will never arrive. The perfect market is not coming. The data says buy in the right market with the right numbers. Everything else is noise. One more thing before I let you go, because I want to address the version of this question that almost nobody asks directly, but almost everyone is actually thinking. The question is not really, should I buy now or wait? The real question is, what if I buy now and I'm wrong? What if rates stay elevated longer than expected? What if rents flatten or dip in my target market? What if I get a bad tenant on my first property and I have to go through an eviction? These are legitimate risks, and the honest answer is that all of them can happen. None of them are reasons not to invest. They are reasons to invest with margin, to buy below your maximum price, to hold 3 months of reserves in cash, to hire a property manager who has a proven screening process, to target B-class neighborhoods with stable long-term tenant demand rather than swinging for maximum rent in volatile markets. Risk management in real estate is not about avoiding risk entirely. It is about buying enough margin into the deal that the realistic downside scenarios are survivable and the upside scenarios are meaningful. If a deal only works when everything goes perfectly, it is not a deal. If a deal still works when 1 or 2 things go moderately wrong, that is an investment worth making. Stop waiting for the perfect market. The data does not support it. The math does not support it. And 10 years from now, you will not be grateful that you waited. You will wish you had started sooner. In the next video, I am going deep on house hacking, how to buy a small multifamily, live in 1 unit, eliminate your housing payment entirely, and use your full salary to build the portfolio faster than almost any other strategy available to a W2 investor. Subscribe so you do not miss it. Drop a comment below. What is the one thing that is currently keeping you from making your first offer? I read every comment and I will give you a direct, honest answer. See you in the next one.